Hi, everybody. My name is Max Friedrich. I'm a fintech analyst at ARK Invest. Together with Nishita Jain, I cover all things fintech, but especially digital wallets, which is the big idea for this year, and which we're going to take a closer look at right now. So we're going to lay out our thinking around digital wallets, what differentiates them from each other, but also from banks. We're going to compare them to banks. We'll come up with their total addressable market, their TAM, and then we're going to size the opportunity. So with that, we're going to jump into the first slide. But before getting to the content of the slide, let's first zoom out and think about what is a digital wallet. We define a digital wallet as an application on a user's smartphone through which they can access different financial but other also commercial services such as e-commerce. We call them bank branches in users' pockets or handbags. They really first emerged in China with WeChat Pay and Alipay in the early 2010s, and since then have risen to billions of users, and you can really find them in all different geographies and markets around the world. The rise and dominance of digital wallets also is reflected in their dominance as a payment method, as you can see here in this chart. So on the left side, you see that on a global level, digital wallets are the number one payment method for e-commerce purchases since around 2017. And since 2020, you can see that on the right side, they're also the number one payment method for physical point of sale purchases. And we think that's likely as a result of the COVID-19 pandemic, which encouraged many people to shift their payments preferences from cash to digital. And this is a good moment to pause and quickly think about the COVID-19 pandemic and its impact on innovation, because that's a theme that really runs through this year's Big Ideas presentation. The COVID-19 pandemic accelerating innovation, and that certainly also is true for the fintech space and the digital wallet space. We think that the underlying shifts already were in place before the pandemic, the shift to digital payments, to commission-free investing platforms, but we think, again, they were really accelerated. And not only accelerated, we think they were cemented into consumer behavior and habits, not only in the form of short-term trends, but really long-term secular shifts. And there's a lot of empirical data to support this. So on a company level, most companies in the digital wallet and fintech space report higher user numbers, higher engagement numbers today than before the pandemic, and even relative to the height of the pandemic, which is pointing again to the lasting effect of these changes. There are also many examples from an industry perspective where, for example, in 2020, we saw a record number of bank branch closures. The bank branch closures in net are up roughly 40% from 2020, which also was a record year. So the banks are also recognizing the shift from offline to digital. Talking about banks, and here we can jump to the next slide. We can talk about the interplay of banks and digital wallets here. Actually, on the first slide, the intro slide, the title of this presentation was Digital Wallets is Upending Traditional Banking. And we think that this slide and chart really speaks to that, right? So you have Square's Cash App, or now Block's Cash App, and PayPal's Venmo compared to JP Morgan users in the form of their deposit accounts, number of deposit accounts. And what you see is that over the last roughly 10 years, the Cash App and Venmo really have outgrown the number of deposit accounts at JP Morgan at a rapid pace. JP Morgan needed roughly 30 years and 5 acquisitions to reach roughly 60 million deposit accounts. And Cash App and Venmo, like I said, less than 10 years to go beyond that. Now, on a revenue per user level, traditional banks are still ahead of digital wallets, although we think that could change, and more on that later. But today, just looking at customer acquisition, digital wallets are clearly outcompeting banks. Customer acquisition and the customer acquisition strategies that digital wallets employ really are a central element to our thinking around digital wallets. It's not only relevant when comparing digital wallets to banks, but also when comparing digital wallets to other digital wallets or other fintech companies calling themselves digital wallets. And it's even more important it's become even more important over the last 2 years, as again, we saw this shift from from physical to digital. And as a result, a lot of attention on digital wallets. So a lot of companies, investors jumped on the, let's say, digital wallet or super app sometimes bandwagon. So while we have researched and written about digital wallets for a number of years, we think that now with this increased attention, it's even more important to look at the details. And there is another kind of dynamic that adds to this, in our opinion, and that is that it's often, we think, difficult for traditional research departments to really understand and analyze and value digital wallets. An example of that is Rock's Cash App, which before the pandemic often was discounted or not really. The analysts were not really much interested in it. But as the COVID pandemic hit and Square's main business, the merchant payments business, was shut down because of the lockdown, there was a lot of attention that shifted from the payments part to the consumer financial part of the company of Cash App. And we think the other investors in the industry is still kind of trying to figure out what to do with these digital wallets. So that being said, we think that not all digital wallets are created equal, and it's very important to go deep and differentiate between them. And like I said, a central vector here is the customer acquisition strategy. So as you can see on the chart, we have 4 different main customer acquisition strategies that we think about for digital wallets. The first one is P2P, peer-to-peer. Digital wallets acquire other users via peer-to-peer payments. This usually works well in markets where there's friction associated with payments, be it domestic payments or cross-border payments. And the digital wallets grow the user base organically via connections between the users, similar to how social media networks grow their user, right? So if you're the only person on Instagram or WhatsApp or another social network, that's not really valuable to you because you need other users to engage with, right? So you yourself have an incentive to bring on your friends and family to exchange with them, and the same is true, we think, for P2P payment digital wallets. And obviously in the US, you have the examples of Cash App and Venmo. You can look to other countries such as South Korea, where you have Toss, or you have Chipper Cash that is active across several countries in Africa. The second strategy is what we call land and expand. And the idea here is that the digital wallet perfects one single financial services use case that was previously not done well, was too expensive, too complicated, that was not accessible really for the majority of the population in a respective market. So they solve this financial services use case and then use the trust established with the users around that one use case to build a digital wallet out of that and attach more financial or commercial services. And a great example of that is Nubank in Brazil, which came out with a credit card a couple of years ago, a mass market credit card in a market, Brazil, where credit cards were only available to a small subset of the population. And then they used the trust established with their millions of users around the credit card to build other financial and commercial services around that. So now they have personal loans, debit cards, investing, e-commerce, and so forth. The third strategy we call vertical integration into financial services. The idea here is that you have non-financial services firm rolling out and cross-selling financial services to their existing, often very large user bases. So the prime examples of this would be WeChat Pay being built on top of WeChat, the messaging platform, or Alipay being built on top of Alibaba, the e-commerce platform. There are also other examples throughout Southeast Asia where you have digital wallets built on top of ride-hailing platforms such as Grab and Gojek. So we think these strategies work well in markets, in developing markets with low financial services penetration, where often users go literally from having no bank account at all to having a bank account with these non-financial services, often kind of big tech companies. So this works well in developing markets, but we think in developed markets, it's not an effective strategy. And we see this kind of play out. We saw Google discontinuing their banking account project with partner banks called Googleplex. Or also you can just look at Facebook, which had Messenger payments within the Messenger app activated for almost all of the 2010s, but you still had Cash App and Venmo building, these tens of millions of users and really large user bases. So in developed markets, it's not enough to just sell somebody, a bank account or a debit card. You have to be more nuanced. You have to have a better customer acquisition strategy. And the last strategy is what we call merchant first, which is where a digital wallet not directly acquires a user, but uses merchants and cashback campaigns and other mechanisms to kind of use the merchants as distribution points to build a network of consumers. So why are these different strategies so important, and what do they actually mean in reality? Well, they yield, in our view, very, very low customer acquisition costs, especially compared to banks, but also compared to other digital wallets not deploying such differentiated or nuanced customer acquisition strategies. So as you can see on the chart, in some geographies, digital wallets pay as little as $1 to acquire a customer, whereas banks in the US, on a net basis, spend $750 on a net new user in paid marketing expenses. Or if you actually include the occupancy expenses that they pay for branches and so forth, that number even goes up to $2,500. Why would we include the occupancy expenses in one of those calculations? Well, we think because bank branches in large part actually are a form of physical marketing outposts of banks. So if you drive past them, you see the logo, and banks will actually, in our view, use that to build a presence and build a consumer mindshare. Although now, as we discussed earlier, in a changing world towards digital, that probably, in our view, is not a good, not as an effective strategy anymore. So in short, we think low customer acquisition costs of these digital wallets gives them room to then invest and to move up market, and essentially puts them at a competitive advantage over, again, banks, but also other digital wallet or consumer finance companies that might not deploy these strategies. So with all that being said, let's now move to the more quantitative part, and let's think about the opportunity here. How can we quantify the digital wallet opportunity after so much is being said about them over the last 2 years? So again, if we assume that they become these dashboards for consumer for all things consumer finance and other commercial applications, we think each digital wallet user in the US could be worth $20,000 to $500,000 at maturity. That's really thinking about what is the value of all the different financial services relationships that the user has, and kind of the monetization that a company could scrape off that. So we do that by basically dividing the different financial services use cases into these categories that you see here: savings and spending account, payments, and so forth. And for each of those categories, we go in and we do we go through a unit economic calculation. So we look at kind of how current companies in the market are monetizing these different services. And we also look at the TAM in those respective product categories, and we then estimate a revenue and an EBITDA, and essentially and finally back into an enterprise value for all these different categories, again at full penetration on a per user basis. So for example, for payments, we take common payment take rates and apply them to the average total retail spend per adult in the US, and do the unit economics and back into the EV per user to estimate the maximum amount of value a digital wallet could extract from owning that part of a consumer's financial life. So in the case of payments, that be that 100% of all the payments that a consumer does on a daily basis is flowing through that digital wallet. Now, this does not mean that we necessarily expect that 100% of digital wallet users around the world will only use that one digital wallet, for 100% of their payments, but enables us to quantify this massive opportunity. And we do this exercise for all the categories you see in the chart. So now, having arrived at a per user opportunity, and really a way how to value that digital wallet opportunity on a per user level, we can translate this to a broader geographic context, and we could apply this to the US. So if we now know that at full penetration, a digital wallet user could be worth over $22,000, if we now assume that in 5 years, 100% of US smartphone users will use a digital wallet, and again, we'll see that 100% penetration. That puts the total digital wallet opportunity in the US at roughly $6 trillion. That is the total addressable market. That's the opportunity at maximum penetration, right? And now you can say, well, let's be more conservative and say it's not 100% of smartphone users will have a digital wallet, but maybe only 75%, and they will be penetrated only by 25%. So the value creation is only going to be 25% of the 100% that's possible. And you would still, in our calculations, end up with a $1 trillion digital wallet opportunity, which is roughly double of what it is today at roughly over 400 billion. You can also translate this to the global context and kind of adjusting the potential value per digital wallet user from the US level to the global level. Again, you can say at full penetration, we're talking about a $20 trillion opportunity, which again is roughly equal to the market cap of financial services users, of financial services companies today. Now, this does not necessarily mean that we think that we're going to end up with 100% penetration here under all of these scenarios. And again, in our 2030 forecast, which Brett talked about earlier, so if you haven't checked out his segment, that was I think the first or second segment of the Big Ideas presentations, you should certainly check that out. We don't assume the full penetration for each and every digital wallet user. Hence, we estimate that by 2030, the attributable market cap of the digital wallets will be roughly around 9 trillion. But by assessing the digital wallet opportunity in this way, we can quantify the magnitude of it and the impact that it could, and to some extent, we think really likely will have, in our view, on the future of financial services. With that, I thank you very much for listening. I hope you enjoyed that segment on digital wallets. You can always reach out on Twitter at mfriedrich.arc, and also be sure to check out arcinvest.com and all of our other research. So with that, thank you very much, and talk to you soon.